To the Kendall Report, where I share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, we saw quite the decline today. Felt like back in the old days of the COVID crash. What can I say? The markets are reconfiguring the entire economy. So let's get into tonight's video. Okay, folks, welcome. I thought I'd do a quick broadcast. I know I always have said if there's a big day like this, I'll try to come back on. And just 2 days ago, we went through the long-term aspects of the markets, and we've already satisfied some of the things I've talked about. So we'll get into that tonight. Well, the room is filling up. Let's kind of recap what happened today. S&P down 484, NASDAQ down 597, Apple down 9, Nike retail down 14. It was literally a bloodbath. And it's kind of interesting when you have the markets responding like this. And I tried to mention in the Substack last night that there's some interesting things going, and you hear all the rhetoric, all the headlines across Europe, we're going to retaliate. What are they going to do? By the way, it's sort of like a dog chasing a car. If he caught it, what would he do with it? The bottom line is the world is going to change substantially, and there's some challenges trying to reconcile as we get into this game that we're in right now. And, it's still overnight. We already saw a print down to 5407. We rebounded about 20 handles off of that low already. So we're starting to get, I think, to the point where we're going to see maybe some stability. There's been zero liquidity in the markets. A lot of action, but when I talk about liquidity, I look at the bid ask on each side of the markets, and they're very thin, so you see a lot of volatility and price movement. There was a stage today, I saw a 30 handle run, so the S&P went from a 40 handle to a 70 handle in 1 minute. 1 minute, okay? So it's pretty treacherous trying to trade in there, as far as if you get lucky and put that, you bought it, you just made 30 handles in 1 minute if you could get in and out. The reality is you couldn't. There was a mid 10, 15 handle section in there that was actually tradable. So when you get into these kind of markets, it's pretty tough. I was putting my old pandemic hat on today, going back to March of 2020. A lot of us met back then. I know there's a lot of folks that have been part of this channel since those days. And when I see days like today, I've been around. I'm so old. Okay, I was around the '87 crash. There was a much different today with electronic issues that we have. Back in those days, it was all key punching and writing on paper tickets and stuff. I remember the OEX pit, which I used to trade, which was like the S&Ps now, but in the option pit. There were 2 or 3 different markets across the pit, plus the screens were 20 minutes to 30 minutes behind on the crash of '87. And, so you have to remember, '87, we dropped 40% in 3 days. So this is really wimpy kind of stuff that we saw today. 5%, the end of the world, not so much. But what we're going to see here, this is kind of, we'll go through a little bit of an opinion. I've got a bit of a plan from what we're going to go through tonight, just to set up some ideas, because we've got to be able to cope with this this volatility, and I don't think it's going to go away right away. I think we could see 2 or 3 weeks of these spike volatility events, up and down, by the way. Someone's going to come up and say, oh, we got a deal, we want zero tariffs. And I think in the end, the funny thing will be is all the people that are trying to jump over Trump, in the end, you get another Trump was right again. If he rebalances all of this trade, it's going to be a phenomenal event. I don't know that they can, okay? I'm not predicting, I'm not anything. But from a volatility standpoint, we're going to see a bunch over the next several weeks, maybe months. We're going to have events where somebody's going to say something in reaction to something that will trigger the algorithms like what we saw today. And Todd is saying the percentage of drops is nothing compared. However, it was first from I don't know that it was worse. I don't see it that way. What's happened with the markets is that they've gotten huge. A lot of, I wasn't part of the retail community before, and I guess I'm out on the fringe of that yet, but I still think that the retail has become much more powerful than it was back in the early days. I mean, I didn't consider, it wasn't until the pandemic that I had any retail exposure at all. I worked totally in an institutional environment. So from the standpoint of where we're at today, when you're losing money, you're losing money. And on big days like today, they're never good. A lot of people lost money. It seemed to me that, that folks would have had maybe been ready for this. I'm going to talk a little bit like our WaveTech product and our portfolio products, we're anywhere from 40 to 60% in cash. And we've been selling pretty much all year. We've been net sellers, and the short-term database, which I cover every day in the Substack newsletter, I talk about what the percentage of the moves are and what's going on. It's still been very cautious. We're going to get a look at the run here in just a few minutes. I'm anxious to see what type of issues came out of the short-term database tonight. So we'll take a look at all that stuff. So going to cash a few days ago was a good idea. It should have been in a lot of cash 2 months ago. This should not be something that you should be surprised and just got lucky for a couple of days. Anyway, let me just look at a couple comments here, and then we'll get right into it. And I agree with finally we have a president stands for the U.S. Listen, Trump's not going to back down. Okay, he doesn't care about the stock market at the moment. He cares about this reconfiguring of the economy and not the economy, the world trade system. It has been so jacked up. If you think, I mentioned in my little historic look back on the Substack, I think it was 2 nights ago, one of the things that I talked about is the U.S. had such a crazy, 1945 and World War II. After World War II, we have such a crazy economy here that we could basically give half of our economy out to all of Europe that got destroyed during World War II, and Japan and everybody, and all these imbalanced tariffs, and no one ever fixed it. And the Marshall Plan, right? No one ever went back and said, "Oh, they're all okay now. Let's rebalance." Trump's doing that, and boy, I'm telling you, if you've been on the other side of that, if you're France and anybody in Europe, Germany, everybody, you got to be really angry about this. I saw somebody talking about that, our biggest ally is turning on us. No, you guys have been turning on us. So, we'll see how this all plays out. I believe the Trump administration is going to follow through. I hope you guys watch those all in. I did put the links in the last video for the all in with Lucknick and also with Bressett. You got to watch those. If you don't, they told you exactly what they're going to do. And I saw Scott Bressett in front of the White House. I think it was earlier today. He goes, folks, don't retaliate. Just sit back, think about it for a few minutes before you just start slamming around. And that's what we're seeing right now, even with the markets, folks, is everybody is panicking. This was panic selling everywhere out there. And I don't think I would be getting into that game. I try to keep everybody. I was looking back at some of my headlines that I had. Just going back, I'm just looking here. You know, one of the things that I think is huge that's going to happen is that I feel like that the Fed is just, you know, people are like, oh, the Fed's going to get in now and they're going to fix it. No, they're not. The Fed can't lower rates. They can't do anything. Things aren't going to bounce back. This is a much different game. So the Fed's out of this picture, and I tried to point that out. So let's go in. Let me put on this other screen here, and let's just talk about this chart. So I covered this chart a couple of days ago, and this is the quarterly chart for the S&P, and this is I'm looking at my screen back to just on the other side where I'm setting is 1977 to current. And so this is, every bar on this chart is 3 months. And what we're looking at here, I mentioned that we got one of those outside reversal bars in the first quarter. And we're going, there's two things that we have to do is we have to make a lower low than last quarter. We've done that now. And then we just have to close lower. So right now that close would be, I'll put this out there, that's good. Anything under 56.11. Now this end of the quarter, we're what, 3 days into the new quarter. Okay, so we got a long ways to go. So this, at the end of Q2, we need to be below 56.11. If we are, then we're likely to get 2 more quarters of downward movement. I'm going to bring up another chart here that I think will, is I put in the newsletter the other night, and this was the chart that of basically a channel that I'm expecting to see unfold. 5112 is the first deal. We're down here at around 54. We may just go straight to 5100. You know, I've told you folks, I warn you all the time, if I talk about these any numbers that I mention in these broadcasts on YouTube or on Substack, we almost go directly to these numbers. And you can see the sequence of events that's here, 5112, and it's not going to be straight line. There's going to be bounces here. What was interesting, what I just said a couple of nights ago, I thought we would go to around 5,800, maybe 5,860. Well, we went to 5773 and we got a huge rejection just a couple of days ago, and then we made a new low already. I still think we have some, and I'll go through some of the short-term analysis here, and we're going to stick primarily to the S&P. We're going to go through a number of things in this, but this is this is going to be probably what's going to happen. And I was talking to one of my old institutional clients. I know he watches the show a lot today, and we were just talking about. And I've been saying this, you can't have a 52.5% compounded rate of return for 23 and 24 and not expect that we're going to get a correction. So, I mean, this isn't, I don't think, anything to do other than everybody's realizing we're in, you know, I hate the 10%, 20%. I think the Russell may have went to minus 20 off the highs. I've been a troll on a Russell for a long time. That thing's just in big trouble. And then I did see, I think yesterday had Tom Lee. I'm sorry if you like Tom. I just can't respect the guy. He talks to you like he's talking to a little child, anyway, he makes me crazy. And he's not a very good analyst. And if you look at their funds, none of their funds are anything special. But my point of mentioning that is, his big call last year that the Russell would double and all that. And we did make a moment. We made a new high. Maybe we'll cover the Russell a little bit. But this is the scenario that's likely to unfold. I like kind of drawing these pictures and what the perception of what it might look like. We could rally all the way back to the moving averages. The configuration is not necessarily what's likely to happen, but we are looking at some pretty big downside correction here. And ultimately, as I mentioned, is getting down to the 200-week moving average is where we're going. I'm going to bring up, we'll go back to this other chart here, and let's flip this over. Let's go backwards here a little bit. This is the cash, by the way. So let's go to a monthly chart here. We're coming into a number that I was talking about the other day, 21-month moving average. Let me just, the 21-month, let me just get this number, is 52.78. So we're getting pretty close to that. I just was showing you this 51 handle number, but let's do some drawing on the charts and talk about this. Yeah, I see someone saying didn't see any tariffs on Russia. We're not trading with Russia right now. They've been out of the loop since the Ukrainian situation. All right, so let's draw a couple things in here. I want you folks to focus on. So there's an argument from my viewpoint that we're getting that this sequence here was a fifth and final wave. This little target here is one of these pivots that comes out of the wave tech indicators. This is a calculation. We basically hit into that range. This is a monthly cash. And now what we're likely to get is something that looks like this. Let me make these a little thinner. So we're going to get probably a move that once we establish a low, it could be at this 52.80-ish level, which we're not far away. We're 20 minutes from that happening again, and then we should come down to this 40 period moving average on the monthly. And you folks know this, I talk about it a lot, is the reason why I use 10, 21, 40. They correlate if you go to monthly, if we go to weekly, the weekly 200 is similar to the 40-month moving average in value. So this is the target. And then I think and that number right now, I don't have it on the screen. I can't move it while I have these drawings on here. It freezes my screen. But I'll get you the value here in just a minute. But this is literally the angle. That angle is the long-term trend at the 200 week, or the 40-month moving average is your big trend. And you can see if I draw through this, you can see the lows all come through this 40, right in this range. We exceed it by a little bit. So we could come down, and that 51 handle that I was talking about on the previous chart, that's exactly, so we'll go 5280 to the 51 number. I'll pull it up in a minute so we can set up that range. Okay, so but this is, let me clean this up just so we can get this. This is the most likely scenario. We get a bounce somewhere here around this 5,200, maybe 5,100. Then we get a rally back, a retracement, 40, 60%. And then we get the move down to the 40. And this is monthly. That's the end of this year, by the way. By the time that happens, that's actually into 2026 to make this pattern happen. So let's shorten this up just a little bit, and let's get some to some live charts. So those of you that aren't familiar with the wave tech indicators, these dotted lines are the algos. This is machine projections of where they're going to go. So it's projecting a low down in January of 26. And I've been talking about on my Substack, everything that I've been discussing here is that we're likely to get a move down into year end. I've been on a recession thing a little bit ahead of everybody seems to be on it right now. And I think the recession will be more of a very light event, maybe at the end in Q3 and Q4 might run into next year, but you can see that here on the monthly, now it makes sense. You can see this nice upward slope. I've got my cursor running across here of the 40-month moving average here, and you can see that the stability from that standpoint is there. So let's get these numbers out here. 4733. I've got all kinds of notes on this. So 48. If this is the numbers that I talked about on just on Wednesday, was the number is 48.36, 47.45. Then we have 47.33 is this 40-month moving average. The other number that I was mentioning, 51.12. And then if we look at the 21, 52.78. So write these numbers down. 52.78 to 51.12. That's your target for this current sequence we're in. Could go directly there, like right now, like tomorrow. I didn't really bring up tomorrow we've got the employment numbers coming out. Maybe that's a disaster. Everything's going to start to look worse and worse. Some of this is going to be ultimately priced in, but that's why we'll see this pattern again that I was just drawing in. Let me just make sure everybody's got this down, okay? Because this is probably worth the let me just draw this in real quick. So we're going to get this move down to this 21, a bounce maybe back to the 10 that's rolling over. We may get maybe a 40 or 50% retracement, then a rejection, and down to this level right here, which would be that 40 period moving average. And like I said, that's basically into the if you look at a monthly chart, that could carry all the way into the through 26 we could see a big decline. I happen to think that this scenario that we're going through right now, which with the tariffs and this rebalancing of world trade, this is a multi-year situation. I think we're going to have a lot to digest from the standpoint of how these trade flows will change. What's going to happen is really going to come down. Can we get to mostly zero trade barriers? Maybe, but and that in itself would be a huge win for the U.S. as well. But this is the configuration I'm going to go with right now. Probably a decline. We're very close to the bottom of this decline. We could extend just because of the emotion and power that's behind this move. And if we could get a little mini bounce and then a retest of this low, that's why you want to get the Substack newsletter. I'll cover that kind of stuff every day and go from there. So let's see, where are we at in time? We're about 25 minutes in. We can definitely. I'll do Bitcoin. Just remind me a little bit. Yeah, I think. I think all of this stuff. I think the metals. I was mentioning when I covered gold the other night. I think all this stuff is topping out. Looks like a lot of this stuff is going. We're going to have to rethink the world. So just real quick, let me come back up and let's talk about this. Because really, what I see happening here is we're going to rethink how the world works. We're going to have to look at the bond market. Maybe I'll keep going for a while. If you guys want to hang out, I'll go for a while. Maybe we'll cover some of the interest rates. And we saw, really a flight into safety with the huge bid that came into the 10-year today. Is that sustainable? I actually don't think it is. I saw some of these guys. You have to realize that you get a lot of the emotions, and they always do quotes. The financial media I had on CNBC a little bit today, and oh man, it was just gross because of the conversation. It was a very, very biased conversation, but because you get a big bid in the bonds, some guys screaming to buy basically the top in the bonds, right? And it's going to 3%, and the Fed funds are going to go to 2%, and the Fed's going to, no, they're not. Okay, that's not the game. The good news is Powell hates Trump, right? It's pretty obvious. There's not a lot of love between these guys. So that's good because you don't want the Fed to try to meddle in here. It's just not going to be any good. And there's not anything positive going to come out. The Fed's out of this game. I call them a lame duck. The last meeting, I think they become totally irrelevant. And as I mentioned, even in the Substack or the video that I did the other day, is that I really think that the Fed's not going to be a factor, and that these trillions of dollars of capital investment that Trump is hanging on to, is they're going to pull these strategic announcements out. Markets start to get crazy. They're going to go, hey, by the way, we're going to build a new factory in Ohio. We're going to build whatever. And they're going to start bringing these trillions of dollars of capital investment. And this is much more powerful than anything you're going to find the Fed doing. The Fed adding money, lowering interest rates, that's just noise, in my opinion, okay? What isn't noise is capital investments, long-term gains from jobs and stability and rebuilding the foundation of the economy, not just throwing money in it. And it's like putting, we've already seen that game, right? So this is the opposite of the pandemic. They shut the economy down. This is they're rebuilding the economy. If they pull off and they bring up these deals, they got a lot of promises, $3+ trillion, almost $4 trillion. And if they start to bring these out in very strategic times, that this will probably set up this pattern that I've been that I'm showing you right here, where we get this, we get some kind of low during this period, which will probably be this Q2 low, maybe a bounce, even though I still think we're going to get a recession of some sort to come in as we come into Q3, that we could rally into that mode. Recession just doesn't mean markets are going down. And then the second phase will be the final readjustment, which would take us down to this 40 period moving average. And like I said, that's your ultimate 4,800. There's some potential uglier things and that could happen, but I think that's the most sane thing to look at right now. And I've told you folks that have been around this channel for a while that investing's like being on an old country road at night, no moon. You got your brights on and you can only see the next corner. And we saw this corner coming and now we're in the middle of the corner. We'll have to see if we can find another straightaway where markets can recover. But right now we're still on that big corner. You don't want to try to straighten it out too soon. You're going to go off the edge of the road. And the folks that use a lot of what I call techniques of investing while looking in the rear view mirror, they usually just drive off the road. They drove off the road today for sure. So let's try something. I want to show you folks. See if I can get this to work. And I've never tried. I love doing things on the channel that, as most of you know, I do all the analysis real time with you. Yeah, nice thinking on the blasting through the highs by year end. Good luck with that. I think that would take an awful lot, and we're still digesting the 52% gain. I think we could rally back pretty good once this low's in place, but new highs are probably not very likely. But I like your optimism. I love the comment of doing 55 mile per hour in reverse. You don't want to do that, okay? Stop it and just stay tight. So let's take a look. I want to do a couple things here. I'm going to bring up the WaveTech database. I just was looking at the S&P, and by the way, we're 46% in cash on all 500 stocks right now. But what I want to do here is I want to see if we've got the run done tonight. So what I can look at here is, yeah, so the run is finished. So let's take a look and just see what the database looks like. And wow, big time. Let me add these up. 4,500 plus exit signals off of today. We were at 40% bullish yesterday, 26.87%. So we are in what I call full liquidation mode. So 22% on this database is next. If we take that out, then we're basically going down to 12% or lower. And this, so we're a long ways from making any sustainable move on that. I believe if I go back here and just, we're at 33.89. If you haven't been around the channel a little bit, what you're going to see here is anything under 42 is negative and suggests that we're in a trendless to down mode. And we've been below that 42 level for a couple months, actually. I don't usually show this page, and I've actually been wanting to look at this page here, and this is a classic. I was see if I can get this to blow up. You know, I'm on a Mac. I'm just trying to get this to, but let's just stick with it here above me. But this happens. Let me draw something in, and with the database, this is the historic database, and we always get this. And I was thinking about it last night, and I, I almost need to apologize. This is like one of the key elements here. But we get the peak about midway through. This is the peak holding. So we got up to about 75% bullish. This is on intermediate. You can see my cursor just above on this chart. Let me draw in just a couple things here. Yeah, so this is where I'm talking about this peak. It's 2021. This was 22. This is the sell-off. And then we start the recovery. Here's 23. And but here's the big peak. Once we got into 24, I don't have the exact dates here, but roughly this is about mid 24. And then when we made the all-time new highs, this black line here is the S&P that you see here. I just put a channel around it. So this secondary peak, it's like a divergence, happened right into these new highs. And then you get this liquidation. And once you go under 42%, then you start this whole cycle here. I'm going to attempt to draw something in here. This little cycle right here. Let me draw this better. This area right here, which would be the 22 decline, this is what we're set up for. So we're looking at, as we come in further in the future here, I'm drawing outside of the box. If we look at that, then what we're looking at is that we're going to see, get the right drawing tool here. Yeah, we're going to see this black line extend down, and we're probably at least going to get something substantial. Here's the 4,000 level on the S&P. We'll get, well, this would be that 4,800 level. Something like that should take multiple months to get there. Just not going to be a lot of opportunity here. And those of you, especially if any institutional folks that are with VPM or WaveTech, you're definitely not going to get any big bounce here. It's going to be really a protect mode. You can go out on the internet if you see advance and protect. That's something I developed back almost 20 years ago. And what that means is we're in protect mode right now, which means we have at least somewhere between 40 and 60% cash. Only in 2008, we went to basically 100% cash. I don't think we're in that kind of market, but we could end up there. Okay. So a little more in depth here on all of this. So here's what I want to do. And I'm working on a way to distribute this file. You're going to have Anthropic account or Claude. But what I'm going to attempt to do, this is yesterday's sheet that I developed. I'm going to attempt to go back over here, and on a monthly basis, so you have to have all the indicators on that I have on right now. There's 10 of them. So I grab this data here, and I'm just going to Alt-C that, and we're going to come over here, and I'm just going to tell, let's see what happens. I haven't, so what I did, let me get off screen. What I did was I dumped in all of that, all the indicator information from the WaveTech indicators. And I told this sheet, and this is a monthly, right now this is Bitcoin from last night. I'm going to just generate this thing to update this file. So it's interesting because it knows I wrote all the code for this, and what I'm working on, there's a TSX file that will run. You probably could run it in as possible. I've never tried running. If you try running it in chat, I have tried. It won't generate the artifact for you. So this is a React file, which is a programming language, and it will do a presentation for us and give us an idea of what this where the numbers are for the month. So it takes about a minute and a half to run this. I'm working on a product that you're going to be able to put any symbol you want in here, and it's going to do it. I'm trying to get to the point where I can screen scrape, bring it into a module that will run this stuff in the background for you. And I'm hoping to get it so you could have a whole suite of things. And as soon as the data is available, it just pulls it in and does it. I'm working on it. I've developed probably 3 different platforms in software platforms over the last 40 years. And so this is kind of interesting. I always tell everybody it's dangerous when you give me the ability which to do this. So let's see, it's done. So let's see what we get here. You gotta love it when on a live, that thing just broke. So let's see if I can get it back. Yeah. So it's given us some parameters here, and let's just see what's been programmed into this sheet here is that I have all of the ppms, all the rule based on if ppm is greater than this, and there's a bunch of logic that is built into this file. And once you put in the data, it can calculate. So I'm just yeah. There's actually there's a couple errors because it broke. Of course, I thought I'd do this live, but let me just while I'm talking about this, let's just look at some of this file here. It is it's interesting. It's got a trend strength of 3 of 10, which is weak. That arrow should be down. I'm not going to fix that right now. But the bottom line is we're looking at that where the support is. This is interesting. 5520 is S1. If I look up here, it says S1 R1. 5703 is R1. So we printed almost to R2. This is for the month. And on the downside, 5520, 5418, we printed S2. We printed 5407 just a little bit ago. So that is right now. It has a 70. Let me look here. 70% probability that the low that we printed today is the low for the month. Okay, I'm going to tie this together. This is kind of fun. So let's do this stuff together here. So let's go to ES. Let's go to the futures, and let's go to weekly. This will probably be the focus of tonight's Substack that I write later. But we have a potential V bottom setting up here and this is interesting that sheet just pointed it out. What is built into the sheet that I was just showing you, let me pop it back up for a second. Just make sure I got okay, this is the right one. What's popping up there and giving us the probabilities. I programmed and researched all the probabilities for how to identify the market grid. If you're not familiar with my work here, these lines here, there's a thing called the market grid, which gives us an estimate for each bar where the high lows are going to be, and I programmed in probabilities to target where if it says like it's like 70% probability that we're at a low, then I look over here and I do a lot of things where I'm looking for a cluster of ideas to confirm another idea, which is this was showing that this is the extreme. These dotted lines right here where my cursor is, these are forecast with a machine learning that's using some autoregressive math to determine where the indicators are likely to go. And they're showing that peak momentum is right now this week. And this would even tie together if you go back and you watch the replay, if you came in late, what I was talking about is that this panic that we saw today, these can be very climactic type environments. And the only time I talk about volume is when the volume tends to be extreme. Some people think because volume was big today that means it's going to continue, and the answer is that's usually a climactic situation more so than a continuation signal. And a lot of people make, I would say, errors when doing that analysis. But this is telling us that, no guarantee, but right now that this week is going to be the peak. So that doesn't mean that as we come into Monday, Tuesday, Wednesday of next week, we can't print a new low. All of the numbers that I talked about early in this broadcast are still valid. That 40, 48, 47 handle that I talked about, that's probably where we get the bounce from. This looks pretty decent. It's forecasting right now, at least into mid-May, that we'll see momentum bleed off. Still going to be extreme downward pressure. So that means that the 10-week moving average is going to be your point to trade off of, looking for rejections. So if you can find good strategies, what I do is I'll use a daily chart. We got a weekly telling us there's a low. We're going to look for some kind of indication on the daily that we're going to get a bounce, and then from there we'll see a move back up towards this 10-week moving average. And so let's see here. I'm about 47 minutes in. I'm just looking at some comments here real quick. So here's what I'll do. I think I've made a pretty good point there from that standpoint. It's 9 p.m. Eastern. I just heard the bell ring. So what we'll do is I'll go through, some folks let's cover gold. I think that would be worthwhile. And I'll cover, we'll do Bitcoin. And yeah, I think someone's going, history keeps repeating itself. It's not repeating. It resembles, or sometimes it looks similar, but it's always different. You could go through, and I've lived through everything from the 87 crash. You could even argue I remember in 1980 when I first started in the markets, there was a big blowout. The Dow Jones hit I want to say 600 and something. I forget the exact low. I could bring it up, I guess. But so there was a big blow off early on, right after Ronald Reagan came into office. And then we went into this bull market, as some would argue is still going on. So let's take a look at, let's go ahead and transfer. I could keep going on just on this S&P. Let's do one thing before we bolt out of here, okay? I'm going to go to, I got the E-minis up. Let's go to a daily analysis. and let's run that sheet real quick. I'll run it in the background. So all I do is I come over here and I highlight all these numbers, and then we're going to come back over here. I'm going to, we'll come back to this, so we'll let this run in the background. All right, I'll make sure it starts running. Okay. So let's go back over here to the charts, and let's go through a quick rundown through gold here. Pretty ugly. This is daily. Pretty ugly gold chart. We got almost, I talked about this number the other day when we did this 32.21 is this target. We got fairly close. All the gold guys were pretty excited until this morning. It actually bounced back because it was down, I think, 3% at one stage. But one of the things I was talking about just a couple of days ago, this is daily chart, that we're likely just to go in this consolidation, and we're going to stay probably above 30, just trying to get the number, maybe 3,000 to 31. We probably established a high just a couple of days ago. Let's look at the algos. You can see everything's like declining into mid-April, and then maybe some stability. It even runs further with the potential of going down into mid-May. We should see more of a sideways. You can see the red dots are projecting out to the, just trying to get a number here, 3086, that we're going to come into these moving averages. Let's go weekly. Yeah, weekly's actually still got some momentum, but I think sideways, and then somewhere around the end of we'll call it mid-May, the end of May, we might see it move back. It looks like 3,080, 3,000. We'll just round it off. That's going to be the bottom point. I think the momentum has peaked here. Doesn't mean we can't still go higher. We still have live Fibonacci targets here at 3340, 3240 on the daily. So we still have targets to the upside. So we still have upward targets. No sell signals. Nothing to scream like this is a peak. If we look at just purely at the algos here, let me just flatten this out so it doesn't look so crazy. But you can see we're seeing uptrends forecasted way out into 26. So gold is going to continue. We have 3 fib targets up here, and these fib targets come from the wave tech indicators here. And it's actually, these high targets have been forecasted since December of 24. So these are targets that have been out there for a while. So they're still valid. Trends are still on the upside. All right, let's do Bitcoin. I think we still have, this is something that I was talking about. This is a weekly chart, so we'll stick with this in a minute. This 40-week moving average is still pretty substantial, but I want to point out something here. Let me go off screen so we can see it. Is this green dots that are going right across here, those are at 71,400. If we break through that, then we're heading for the 200-day, which is 46,000. And I would tell you that if that happens, Michael Saylor's in big trouble. Um, but the bottom line is we're still holding this upward mode here. And this is, instead of using instead of using trend lines, I use moving averages. And just because they tend, so hang on, somehow I got fat. So this is the 21. Here's your 40. This wedge, and we do have some resistance in here. This is the weekly. We still have some weekly resistance in here, but we should actually, I think we hold this line and we end up trading more into this wedge. And at some stage, let me clear this off. At some stage, we ultimately make a decision, maybe out in May, whether we can turn the corner and get above this. It looks to me that we're in this massive potentially distribution area. And one of the things that I'm not happy with, I know folks want this to be like legitimate, by getting the ETFs and the options and getting the U.S. government in there. I mean, this whole platform was to be not have the government in there. I think you've already brought most of the bad Wall Streeters in there, all the arbitrage guys. Nothing good has really happened since this market got the ETFs and those type of things. So I don't see that being good. I don't see the U.S. government and governments across the planet getting involved is a good thing from this standpoint. I think you end up with some kind of ugly regulation. You've already brought in all the ETF guys. So the SEC's already got all kinds of angles on just about everybody. So that is the other thing. Yeah, I'll do it for you. Somebody's yelling NVIDIA. So this is weekly NVIDIA. Should start to stabilize down here. We had Fibonacci targets back when the market was at 140, 134. We had Fibonacci targets of 103, 83, 72. We're probably going to bottom here. There may be some more. There's the extreme would be a move down to 84. But the algos are suggesting we've got some pretty big downward pressure here. This is a weekly chart. We have PPM1 at minus 3.2. That's not good. This 10-period moving average coming down through here is going to be your rejection point, 121. Let me just see what that's doing. $5 per week. So 121, and we're looking at 115 and then 110. So it's going to narrow down the red dot indicator, this forecast where the price trend is likely to go, and it's projecting in sideways into this moving average. And at this point, we might be able to rally back in. So this is going to be a pretty critical point here, and there could be a spike down if anything goes on. Yeah. I see somebody making a comment about personal savings and stuff like that. Never underestimate the U.S. consumer, I guess. Might be a thing. I don't see that as a trading point. Everything I've talked about here still looks like very legit. I think the standpoint of what we're seeing here, let me just come back on screen here. We'll finish up the stream right here. I'll update once I get down. I'll get everything updated so you'll have links if you want to get the indicators. real quick here. I'm just looking at that sheet I was running. So let me go back. Because we ran this in the background. Looks like, yeah, it looks like we've still got some, we got a 65% bearish factor on here. We're looking at, this is interesting. This little section down here, folks, this minus T, this means we're in negative trends. So all of the indicators, with the exception of the 200 is neutral, but we have big 0.28 on ppm3, 0.28 on ppm2, and 0.52 on ppm1. These are very, very big downtrends that are happening. Let's see here. 53.88 is the low target for tomorrow's session, and we're looking at 54.56 is the projected high. So this sheet here will be, it looks like everything's good. There's only one divergence located, and just looking here. Yep. So just wanted to bring that up. So I'll come back up and we'll finish this stream. I appreciate everybody coming and hanging out. So we focused tonight on the S&P targets, those type of things. We could actually do one of these old school back in the pandemic. Remember, we used to do the Wednesday 3-hour live streams. And so we're not going to do that tonight, but I know some of you would like. Yeah, there's no fibs for Bitcoin on the upside. I think we're seeing a big distribution, looking through some. Yeah, Tom Lee always says the bottom's in. Guys, yeah, he's just not a good analyst. Okay, just not good, and he's a worse portfolio manager if you look at this stuff. I rebuilt. I did a hack on one of the portfolios they started last year, and I doubled their returns, and I'm already protecting assets. Yeah, I'm just looking at some comments here. Yeah, he's always been that way, though. They always bring him out. By the way, Tom Lee, I'm talking about. Tom Lee comes out because they need a guy that will say the market's bottomed. They needed that guy today. I used to always say you could turn the sound off on CNBC. You can see what kind of day it is by the expressions on the face of everybody on there. Big down day like today, everybody's really serious. Big up day, it's like a party. Everybody's smiling and jovial, but not today, right? And it's pretty easy. Yeah. Somebody's saying that we're going to see the biggest stock market crash ever. I don't know. I actually don't care. Most of our portfolios are, I was showing you, are 40% cash. We're at 28% on the database. Literally only 2 out of 10 items in our database are long right now. 3 out of 10 on intermediate. So we're already ahead of this thing. This has been a history of everything that we've done with the portfolio management system. I always kind of laugh at myself at people that don't want to do the work, and there's a lot of advisory firms and people out there that what they do is they just buy and hold, and they stick their head in the sand and they babysit. Very few are willing to actually do the hard work and protect assets. And most of the markets have been taught that you can't time the market, but everybody knows you can, just whether you're good at it or not, or if you have good methodology. So I always, I'll put my famous line out there to close out today is, It's process over attitude and opinions. Attitudes and opinions keep you in when you should be out and out when you should be in. You need to have a process, and that's what I built, the software and the trading models and all that. And I kind of revealed the other night, I'm pretty close to having new trading models to come into TradingView. And there's a lot of things I've been doing that is going to benefit everyone. Yeah. There's always doom sells good. I'm just looking at some comments coming through. Alan just put out there, Brandon Biggs, whoever that is. But, there's going to be this great crash. I've never found the benefit in during the crash. I can tell you that in 1987, September 16th to be exact, I issued a newsletter. I've been writing newsletters, been an analyst for decades and decades. And I said the title was A Risk Reward in Owning U.S. Stocks, and I was just a U.S. stock analyst, is zero, get out. And that was about 2 weeks before the crash. Wasn't really predicting the crash. Those things happen. If they do, there's too much visibility for a crash. And one of the things, just kind of appreciate the questions, because that's a good question, or a good thought, because trying to predict crashes is, you just put it out there. All the people that put that crap out there, they want to go, I told you so, like the guy, well, I told you Trump was going to get hit in the ear, whatever. Those kind of people aren't trading the markets. They aren't doing anything like that. The markets are about probabilities. They're nothing else. And, right now, all of our stuff is saying lower prices. I'll bring up this chart as I close out. I want to close out. Hang on one second. Just trying to bring one last thing up here. Yeah, just bring this chart back up. But this is the most realistic. The interesting thing is, in 2008, 3 weeks before, we spent most of the year 40 to 60%. We went to 100% cash 3 weeks before Lehman failed. We didn't get back in until March and April of 2009. And in that time, by the summer of 2009, we were making all-time new highs. People that were doing the buy and hold pie chart situation, they didn't get break even until 2013. And so there's an advantage of being able to step to the side. So like, here comes a train. I think I'll just move to the side and let it go. But this is a realistic expectation. Our models are at 28% now, probably not going to get better for a little bit. And then our intermediate models will continue to sell out. We only have, by the way, if we went through everything, the intermediate models right now have one sector long, and that's it. And so everything is blowing out completely. I'm just bringing this up real quick. I just want to see where on the intermediate we have utilities is the last one, is up 27%. It's been long since March of 2024. It's the last of the Mohicans. If we go over to the daily database, there's two. Look at the basic materials, energy, all of this stuff got dumped out for tomorrow. So we're down to two sectors long on a short term, and one of those are underwater. It's probably on its way out. And, so we're probably going to see all the sectors disappear everything's going to disappear from that standpoint. So I don't have the link there, but I will put it in the description. If you're in here, you can get this database and all these models and everything for I think $97 a month, and it's so you can have access to this. 14,723 items in there, mutual funds, ETFs, individual stocks, everything's in there. And plus there's a lot of analytics that go on in there. But anyway, and you can get our indicators too. Soon you're going to have those sheets I showed you run. You're going to be able to run those sheets very soon. Working on a project right now. I'm hoping that by mid next week, that'll be ready for distribution, at least for folks to be able to use manually. The product's still not done, but we're working on it. Thank you so much. We had quite a few people watching, so I appreciate everybody coming out. And I'm sure there'll be a lot of replays on this. I think last video, only about 5,000, should be a lot more, but YouTube hates me. Anyway, love you guys. Thank you for everything. Thank you for your following. See a lot of names that are out there that have been around the channel for a long time. So I appreciate it. If you're new, like and subscribe. And I will talk to you probably next Tuesday. So have a great weekend, folks. Get to Substack as well, kendallreport.substack.com. And it's $8 a month, $80 a year, $650 a month, I think it is. All right, folks, have a great one.